Hey, John, it's great to be here together again.
Thank you, Carl.
There's a lot of discussion in the marketplace about Fed action and where we think rates are going. So thought we would start with where do you think rates are going to go and what do you think the Fed will do as we venture into 2026?
Well, if you look at 2025, the yield curve has steepened and the Fed has been very, very slow to cut. The forecast, I believe, is most likely for 2026 is that they will continue their rate cutting campaign, even though there's a tremendous amount of debate around some of the fundamental criteria. On the one hand, they're looking at some softening in the job market, which could be getting worse. Then on the other hand, inflation has been a bit sticky in the high twos versus their target is 2%. On the inflation front, though, I do think there is some fairly constructive news in the pipeline and that they will continue to be tilted towards being more protective of the job market weakness and therefore want to be still in a cutting mode. When it comes to the pipeline issues with regard to inflation, I feel as though we've probably seen the worst of the tariff influences. The tariff effects appear to be coming in around 10% total effective tariff rate. That could be the peak. We also have a potential Supreme Court ruling kind of maybe limiting some of the tools there. We shall see. But also not all of that 10% effective tariff is actually being passed on to the consumer. Meanwhile, things like housing appears to be flattening out in terms of prices, and that has an influence 6 months later on things like owner's equivalent rent, which are important components of the inflation rate as well. So I think inflation is most likely not going to get worse, and the balance of risks favor cutting because of the softness in the job market.
So I'm hearing inflation's under control and rates are coming down.
That most likely. I would just add that on December 1st, the Fed officially ended their quantitative tightening program, which means they ended their selling off of Treasury bonds out of their balance sheet, and they will be taking their huge mortgage-backed security portfolio and investing those coupons and amortizations of their mortgage-backed securities into the Treasury market. All else being equal, that should also be a stabilizing effect on liquidity and a downward bias to Treasury yields too.
Now, we spent a lot of time in the municipal bond market, and in 2025, on average, corporates and governments did significantly better than municipal bonds. Particularly high yield had some challenges. Can you kind of address what happened in 2025 and why you think that's opportunity for us in 2026?
Sure. In rough numbers, investment grade munis for 2025 appear to be returning around upper threes in total return. High yield munis, at least thus far, with most of the year done, returning around the low threes. So a little bit of underperformance there. Both of those numbers are sharply below the returns in taxables, which have been more like 6.5%, 7.5%, 8%, depending on which segment of the taxable fixed income markets you're looking at. So that's fairly meaningful underperformance. It's also indicative of coupon minus a little bit of capital depreciation, whereas other fixed income has returned their coupon plus capital appreciation. The differential there, I think, is really not fundamental. It's from a fundamental standpoint, things have evolved in a very favorable way over the course of 2025, but the technicals have been soft. Although there are inflows for the municipal bond products that investors typically utilize, like ETFs, mutual funds, SMAs, they've been positive. But the new issuance has just been at an incredible pace. Record-setting pace in 2024, and then a new record being set in 2025, depending on where the year finishes out, homing in on somewhere in the neighborhood of 570 to 580 billion. And prior to last year, the market had never issued over 500 billion. So a very, very significant upswing. And that plus some treasury market volatility, plus selling of municipals for taxes, plus some of the tariff announcements from earlier in the year has made for more choppy market conditions. I would say munis have not fully recovered from that volatility, and yet the fundamentals and the tax benefits are still sound.
So I do note that you're at 20-year highs in yields today for the high yield muni space, probably because of this undervaluation. So maybe talk a little bit about how do we have 20-year highs when fundamentals you suggest are pretty secure. So how does that bode?
Yeah, I think that puts us in a great position heading into 2026 for some catch up and for some improved performance. From a performance standpoint, of course, over the long run, the income delivered, the coupon delivered, the absolute yield delivered tends to be the base of your return profile. In the short term, that can be create a differential. In the short run, the price movements up or down can differ from the coupon earned, but usually your return starts with the coupon. As I mentioned, this year looks to have been coupon minus a little bit. Next year could easily be coupon plus a couple percentage points of returns. In part, munis are heading into the year 2026 at relatively cheap valuations, particularly when you get out of that very, very short duration segment as you go intermediate and then beyond intermediate into the long end of the curve. The muni yield curve is steeper than treasury or taxable yield curves, meaning munis are cheaper as you get longer, even on a relative basis, not just an absolute basis. Then tax benefits have effectively been affirmed for the foreseeable future. We do not expect any major tax legislation to come up in the rest of the Trump administration. So the 37% tax bracket, the 3.8% Medicare tax from which munis are exempt, that gives munis a very good taxable equivalent yield for many investors. And then fundamentally speaking, we will see in 2025 the fifth year in a row of upgrades exceeding downgrades. From a high yield component, we'll see very low levels of defaults. And then from a revenue standpoint, still looking at 5 to 7% annual increases in tax collections at the state and local government level, from property taxes, from personal income taxes, from sales taxes being the big ones. So all of those argue that with sound fundamentals, strong tax benefits, and good valuations, that we should have a coupon plus capital appreciation type of a year in 26.
Thank you, John. Great as always.